David Booth, a founder of Dimensional Fund Advisors in 1981, is the firm's executive chairman. He has served on the Investment Company Institute's Board of Governors and the ICI's Executive Committee. The University of Chicago Booth School of Business was named in his honor, and David also serves as a lifetime member of the school's advisory council. David Booth Kansas Memorial Stadium at the University of Kansas was also named in his honor. David funded the Booth Family Hall of Athletics in Allen Fieldhouse at Kansas University and donated James Naismith's original 13 Rules of Basketball. David received his MBA from the University of Chicago in 1971. He also holds an MS and a BA from the University of Kansas.
So that leads me to one thought here, in that that's probably the most simple application of indexing.
Yeah.
Is let's buy the S&P 500.
Right.
Okay. So here comes along a lot more academic research saying, well, what happens if we carve up the market into some segments of distressed companies, small companies, basically companies that have a little more risk than you might see in the S&P 500,
Right.
which leads us to this whole factor investing,
Right.
or asset pricing model, and generally speaking, another part of Fama's Nobel Prize, and to really the founding of Dimensional,
Right.
because you're saying, well, the S&P, that's easy. A lot of people are already doing that. If I'm going to start a business, maybe I should come up with something a little different. So
Right.
let's move now into different dimensions of the market, which
Right.
led to the idea of dimensional fund advisors. And let's talk about small caps first, and then let's talk about value, and then maybe even move into these two new factors, profitability and investment.
Okay.
So,
Well, part of this, if you have a successful business, you have to have a certain amount of good luck along the way.
Absolutely.
And that happened kind of at the creation of Dimensional, and that our first strategy, as you point out, was a small cap index fund. We call it an index fund. Later we switched the name to Dimensional, and we can talk about the reasons why. But
yeah.
But let's call it an index fund. The idea, because by 1981, now indexing had been around 10 years, and it was pretty well accepted. But all the index funds at the time were S&P 500 index funds, or IFA, the International Index Fund.
Okay.
And I'd done a consulting project for AT&T, which at the time had the largest pension fund in the world.
Okay.
This is,
Wow.
as you recall, back in the old days, there was just one telephone company, Ma Bell.
Before they broke it up
They're all
into the
up,
baby
yeah.
bells, right?
So all that pension money was in one spot.
Wow.
And
Okay.
the forming of Dimensional was really around an idea more than research. And the idea came about because in looking at their portfolio, they had 110 managers picking stocks. And I said, I don't know what you've got with 110 managers, but you've got something that has no chance of beating the market, because these guys are all trading with each other, and
Plus high fees.
high fees, and and you know what? None of these 110 managers is holding the stocks of small companies in any meaningful way.
Right.
The only small cap was a term people didn't even use then, but by small capitalization, or think of a smaller company.
Yeah, small company. Yeah.
Small cap. The only small cap stocks they hold had once been big cap stocks. I mean, that's
It got beat up.
yeah.
for
So
whatever reason, yeah.
that's the only. If you want to do yourself, if you want to index something, why don't you index the stuff these people aren't holding?
Yeah.
Because from just simple portfolio theory, you ought to have a portfolio of large cap and small cap stocks.
Diversify.
You should diversify.
Diversify.
Voila.
Yeah.
In 1981,
That's-
people would get excited about this idea. It's like,
Okay.
this is fabulous idea. So we decided we would do.
That's actually apart from the fact that they might have higher returns. What
Right.
you're really saying is get a little of each, and you smooth out your ride through
Right.
the diversification, right?
Right. Because the reason we didn't talk about returns is because we didn't have the data. Okay. So we started, and we got our first commitments, and as we're getting commitments, I go, holy cow, I think there's really a business here. And so I called up FAMA right away because I thought, you want to be current on research, academic research. And in terms of academic research, FAMA's the guy. He was back then, still is.
He is today.
Yeah. So
the guy, FAMA.
Yeah. So, and it was like no time had passed. I said, and keep in mind, he doesn't do consulting work on the outside, but he was willing to join our firm as an outside director, as a director and founding shareholder of the firm. And it paid off immediately because over dinner, chatting about what we want to do, he goes, small cap. I said, we had a student here a few years ago that did his dissertation on that, a guy named Rolf Bonds. He's now teaching up at Northwestern. Why don't you contact him? So we called up Rolf. He was flattered that anybody would read his dissertation. And we had, keep in mind, we had no money. So we said, but we were creating a mutual fund to invest in small cap. That it's still here, the micro cap portfolio. That we end up next week. It'll be its 34th anniversary. Live data.
Wow.
Okay,
34. Wow.
Yeah. So
that's crazy. It was called the 9-10 fund originally because you had the market in deciles and 10% little pieces, and they were the bottom 20%, right? Of all the stocks on the New York Stock Exchange, right?
Right. So Bonds had done it that way. He didn't.
Okay. He laid it out that way. Yeah. So these are dimensions, slices.
It was incredibly important for two reasons. Three reasons. One is it's good to have the data, the information. That's incredibly important. But two, he got his PhD on this, so it had passed academic muster. Great. We knew nobody could challenge, the research. And three, we could get it for nothing. We said to Rolf, if you will give us the data, we will put you as a director of the mutual fund. So he was more than happy to do that.
Sure.
Now, as a sidebar story on that was, we realized right away we didn't want to run it like a straight index fund because of transaction costs.
Especially
if you hold the smallest 20%, names are coming in and out of that bottom 20% all the time, and you would just generate enormous trading costs if you treated it like an index fund. So we said, okay, we got to cut down on it. It doesn't make sense to have a lot of trading.
Right.
I mean, we at the same time, if you never trade, then pretty soon you no longer have a small cap portfolio. So we said, why don't we go out and test? We'll wait until a company gets to be 50% bigger than the biggest company we're then buying. Then we'll sell it. Yeah. So we'll have a buy range, a hold range, and a sell range.
Right.
So Rolf, can you simulate that for us? Sure. Here again, no cost. He runs the data, and
great.
It comes back. Here's the interesting point. It had that strategy, which would most of the time would have about a third of the portfolio, and deciles 8 and above. Because we had the hold range.
Yeah.
And we know that the bottom 20% had a much higher return than the 8th decile or the 7th or any other.
Okay.
But this simulated portfolio had exactly the same return as the bottom quintile. And we thought, that's just a data quirk. We didn't pay much attention. Well, years later, research starts showing evidence of momentum. And so we had the first research on momentum. We didn't know
Didn't even know yet.
We didn't even think to look at it. We just thought it was one of those things,
Right.
And one of those crazy things. So
okay, so you've diversified into small caps now, right, versus the large cap world of S&P 500. But then came some research from Fama and French about this value sort of distress and excess returns or premiums tied to value.
Right.
So what was this, 92,
91? The 92 paper, the cross-section of expected returns paper,
So hang on, I just wanted to talk about cross-section. When I first heard that term, what's a cross-section?
Yeah.
It occurred to me later, a cross-section is a dimension, which is kind of an index, right?
Yep.
They're all kind of similar, even a style, if you will. There's so many terms.
There's so many terms.
This is the problem with this industry.
Yeah.
I'm a nuclear pharmacist from training. I come here, where's the dictionary of all these academic terms? And there basically wasn't one. What's small? What's value?
Yeah, right.
all
we
these
come up with simple words. Although I must say, I've always tried to work in the word heteroscedasticity into an argument because nobody knows what it means, but it's such a cool word,
That's a
know,
cool word.
which obviously just means that the variability of the market is variable.
Okay. Yes.
So anyway,
Yeah.
but these we have to get around all these terms. But
Okay,
what
let's go to
happened
value
was-
now. Yeah.
So we
And the
have a
value
generation.
paper.
By this time, we have a generation of people, of academics, that had weaned their teeth on the capital asset pricing model,
Right.
which is what Bill Sharp got his Nobel Prize for,
Right.
along with Markowitz and Miller in 1990.
Yep.
And that model said that basically returns should line up with beta. Stocks that are more volatile would have a beta greater than 1. Stocks less volatile, beta
Then the
less
market.
than 1.
Then the
And
market.
is-
More volatile than the market should have a little more
Yeah,
return.
yeah.
Basically, you're
Yeah.
getting paid for a little more standard deviation, right?
Yeah,
a little
yeah.
more volatility.
Yeah. And it was a great model. And, and of course, in the academic community, they do have a saying that if you torture the data enough, you can get it to confess to anything.
It'll confess, yes.
But as much as what had happened was,
What do
as
you
much
want,
as they,
what do you want me to say?
yeah. As much as they tortured the data, they could never get it to confess that high beta stocks had significantly higher returns than low beta stocks, which is a problem. A great theory, no empirical support for it. So that's kind of a useless theory, even though, regardless of how elegant. So as researchers investigated in returns, what they found were what they called a lot of anomalies.
Okay. What's an anomaly? Just for
Well,
our
an anomaly
audience.
is a return that you can't explain.
Thank you. Yeah.
It's something the model can't explain, an average return. And as Merton Miller used to say, anomalies cling like barnacles to a ship. Eventually, either you explain them away or they sink the ship.
Interesting.
And the capital asset pricing model basically was sunk. And or the final blow was the Fama French paper in '92,
Yeah.
which pulled together all these this research into anomalies. And they said, really, what's going on here is kind of the relation between risk and return is somewhat more complicated than we thought. Not surprising. But instead of trying to explain risk and return with one factor, beta, let's go to a series of factors, multi-factors.
Multi-factor.
Okay, and they basically, in some ways, their research was not all that original, but it was kind of like pulling together all the research that everybody else had found together, and they pulled it together in a simple, what they called three-factor model.
Right.
So they said, the relation, average returns are related to, beta, but that doesn't
To some
explain
degree.
much.
Yeah. Doesn't tell you much. What does it explain? About 70% of
Yeah,
returns?
the
ballpark?
variance, it absorbs a lot of variance, but
Yeah.
but in terms of explaining average returns, it doesn't seem to explain much of average returns. But what
So
they
then-
found was these other two dimension. One of them, we were
Size.
lucky.
Size, you were already there.
Small cap versus large cap. We'd lucked out. We
You'd
didn't even
stumbled
know.
into that one, huh?
We didn't even know about the dimensionality.
Yeah, that's interesting.
But what's funny is we did kind of think of it as dimension.
Right.
That's why I came up with the name of the firm is dimensional.
Right.
Because I thought of that as being a separate dimension.
Yeah.
We just didn't have the elegant research support for it at that time.
Right.
So we have the name and the firm going for 10 years before we get the justification for it. But that was one of the dimensions.
So then value comes along.
And
so talk about value a little bit. Where did Fama and French originate that research, or were there some other
there was,
papers floating around?
basically, if you look
Basically,
at
all these papers are built on something
yeah,
else.
right. There's
They're
a
all
whole,
being built.
there's a very robust literature at the time.
Yeah.
They in terms of anomalies, they found that low price earnings stocks, price to earnings stocks or earnings to price, whichever, low price to earnings stocks had higher returns than high price to earnings stocks. Low price stocks, low price to dividend, in other words, high dividend yield.
Right. Basically, this price is discounting the uncertainty of that dividend
Yeah.
or of something
Yeah, right.
into the future, right? And if
So-
the price is low, the market's saying, wait a minute, those are kind of uncertain.
Now academics invert it. Instead of doing price to earnings, they go earnings to price.
Right.
So companies that have high earnings price
Right.
have greater returns than low earnings price. High dividend yield have greater returns than low dividend yield, adjusting for their volatility. Or price to cash flow, or any. And what happened was, as long as price was in the denominator, in fact, one over price. If you just
Right.
look at price itself,
Price itself.
it explained differences in average returns.
Yeah.
Not as well as these others,
Right.
but the best way of characterizing this three-factor was to look at price to book. They concluded
Right. Right.
that mainly
Or actually,
because
book to market.
Or book
right?
to market.
That's basically
Book to
BTM.
price,
There
yeah.
was a little code that
Yeah,
they
yeah.
used in the paper, right? Book
So
to market.
you want
So you got the book value. I like to say what an accountant says the
Yeah.
company's worth.
Yeah.
And then you got the market price.
Right.
And the gap between those is goodwill, typically,
yeah,
right?
Yeah. So anyway,
In essence, the more the goodwill, the lower the return over time. But go ahead. I'm
yeah,
sorry.
yeah. So that became well, you think of it, it's low price, low
Right.
price to book or high book to price, whichever you want to look at. But I like to think of it in terms of lower price because that gives you an idea. Because we know the lower the price, the higher your return. But price by itself can't be the answer. It's got to be scaled by, because
Something.
otherwise people would do a 2-for-1 stock split and your price would shoot up. You know, I mean,
Of course.
yeah.
Of course.
So it has to be priced relative to something, and
Yeah.
price to book. Now, so Fama and French came out with this, and the investment community said, "Oh yeah, those low price stocks, those are value stocks." So okay, Fama and French said, "Okay, we'll call them value."
Right.
And that was the first time, in any meaningful way, that people put the label on low price to book as value.
Okay.
Until that time, there were all kinds of wild ways of. It was in the eyes of the beholder how you defined value, but
Sure.
since then, most people have accepted this notion. And by the way, this simple three-factor model that Fama developed, and there have been some add-ons, we'll talk about it,
Yeah.
but that's still the basic model that serious academics use with maybe some refinements. But now that's been over 20 years, right? Once again, if you have high-quality research, it repeats.
That's right.
And
That's
that's rare in economics.